introduce myself. I am Graham Jackson. I am the tax partner at Hassans at the moment, and I've worked in Gibraltar for 20 years. I noticed from the attendees, the participants, there are some names that I recognise and some names that I don't recognise. Hopefully you'll, those of you who know who I am will know that I've been in this business for about 20 years now. I've done the job of company administrator, I've worked as a paralegal in funds, and then I retrained, became a solicitor and stayed with the firm, and now I am the partner that works on matters tax related in this way. So just to explain the background to these sessions grew out of some training sessions that I did for the firm, and they are 4 small, short sessions, though hybrid mismatch isn't very short. The point of them is to be bite-sized. They're easily accessible and will be helpful, hopefully, for everybody who works in the fiduciary industry, for anybody who's an accountant, for anybody who deals with directors and company secretaries, and I hope that I've seen there's some banking people who are participants as well. Hopefully it will help you at least be aware of some issues which you may need to be asking about, and generally to give you an idea of the tax landscape at the moment. If you aren't aware, the tax landscape at the moment internationally is becoming much more compliant and driven by a levelling of the provisions across the world. So we are seeing multilateral projects like what's called the BEPS project, whereby the 150 something countries that have signed up to BEPS have agreed that what they will do is they will implement consistent anti-avoidance measures, and taxes will be modelled in the same way, and essentially to eliminate the opportunities for playing between the gaps in different tax regimes. What we're going to talk about today, the exit tax, is a response to that OECD BEPS project. Coming down the line, there is also the taxation of the digital economy and the possibility of a global minimum tax rate, which I will talk about in another session probably. But there are many changes coming, and as Gibraltar is now starting to enter into double taxation agreements and interact more frequently with other jurisdictions, then those of us that work in accounting and fiduciary and tax in Gibraltar are going to need to be much more aware of these global changes. But specifically today, we're going to talk about the exit tax. And the exit tax is a response to BEPS and also a European mandated, sorry, I'm having trouble sharing. There you go. Mandated provision that we've had to introduce as a result of the European Union. And I know that we've left the European Union now, and we're in the transition period, but as part of the Anglo-Spanish agreement on Gibraltar, the provisions of what's called the Anti-Tax Avoidance Directive, or ATAD2, have to be enforced if the deadline for implementation had passed by the time we left the EU. And it did, it passed. The deadline was 31st of December and we left on the 31st of January. So we needed to implement. And that's why we've done this. Now, one of the great central tenets of Gibraltar taxation is that we do not have capital gains tax. The exit tax is a type of capital gains tax. It's no longer true to say definitively that we don't have capital gains tax, though we don't have a traditional capital gains tax. We don't charge any capital gains tax on individuals. But for companies in certain circumstances, this may be the case. So it is, and the title of the presentation tells us that, a radical departure for us. We have never had anything like this before. And we are going to need to get used to this idea that you can pay tax simply as a result of capital growth in certain circumstances. So what is it? Well, it was introduced on the 30th of January 2020, as I said. It's an implementation of the Anti-Tax Avoidance Directive 2, ATAD 2. It is designed to ensure that tax cannot merely be avoided or be avoided merely by relocating tax residents. So it's really important for us to remember what tax residence or what the test for tax residence is in Gibraltar if we're going to think about this. So the test for tax residence in Gibraltar is not whether you are registered here. Now, that's relevant for some tax provisions, but it's not whether you are registered here. It's not whether you are incorporated here. In the definitions of tax residents, ordinary residents in the Income Tax Act, it states specifically that it is either the fact that management and control of the company occurs here in Gibraltar, or it is exercised by people who are ordinarily resident in Gibraltar. So a Gibraltar company which has its directors living in Sardinia, Crete, and Athens, who fly every quarter to Athens to carry out their directors' duties and exercise management and control, is not tax resident in Gibraltar. It is incorporated in Gibraltar. Some countries, UK, Romania is another one, Spain's another one, have an incorporation equals tax residence test, but we don't. We rely solely on management and control. So this is designed to ensure that you cannot avoid tax just by relocating, in our case, the management and control of the company, or by re-domiciling it, or by whatever. Now, that's great, but we need to remember that that wouldn't be avoiding any Gibraltar tax, because we don't have capital gains tax in its traditional form. We only have the exit tax. So this is a solution to a British problem, or a French problem, or a German problem. It's not a solution to a Gibraltar problem, but it's a solution that we have had to implement. So it will throw up some odd results, basically because it doesn't fit with the framework of taxation that we have here, but we have implemented it and we have to carry it forward. So how does it stop you avoiding tax merely by relocating tax residents? Well, it taxes all accrued but unrealized gains on an asset held by the company for the period the company is resident in a jurisdiction. So let's imagine a situation where, let's say it's a Portuguese company, right? The Portuguese company has its directors in Portugal, it's tax resident in Portugal, it buys some shares in a quoted entity wherever. And then it thinks, oh, I'm going to sell those shares because I made a big gain, but I've not realized them. I'm going to sell those shares. But I will have to pay lots of tax on it if I do sell those. So what I can do is I can move my directors and re-domicile to Gibraltar or wherever, where they don't have capital gains tax. Then I'll sell the shares. I'll get the shares tax-free. I'll get the profit tax-free. Great, that would work. But the exit tax will say the moment you leave Portugal, Portugal can tax all of that gain that you haven't realized on exit. And yes, it means they will tax profit where you haven't had the money. That's a cash flow problem, but that's how the tax is designed. And that's something that needs to be factored in when decisions around relocating companies' tax residents are taken. So the final limb of this is that it standardizes EU exit taxes. Exit taxes are common, have been common throughout the EU. And there's been lots and lots of litigation around whether they breach freedom of establishment, freedom of movement, or whatever. The EU courts had found a compromise on what was and what was not allowable under the four freedoms. And the Commission has taken those rules and turned them into the exit tax and then made everybody implement it. So Luxembourg didn't have one, Gibraltar didn't have one, UK didn't have one, or it had a form of one. But now they've all been standardized. And these rules apply with the necessary Gibraltarianizations of the provisions right across Europe. So whenever you encounter a company which is thinking of changing its tax residence, Maltese company, probably you might see that quite often, or a Luxembourg company, you might see that quite often. Whenever you see one of those companies thinking about changing its tax residence, you need to be asking the question, has the exit tax been taken into account? Is there a tax liability in the old country? So, it is contained in Gibraltar legislation. It's in paragraph 18A, part 5A, schedule 4, Income Tax Act 2010, if you want to go and read it. It's important to understand that this is not a head of charge under section 11. This is actually in the anti-avoidance provisions. It's not subject to the normal rules. It is entirely outside the normal taxation system. It is a separate tax. If it wasn't so easily draftable, then I would imagine that we would have actually put this in an entire new act, but because we're implementing a directive, we can use the words of the directive to ensure that we implement exactly as intended. So keep that in mind. This is not a normal tax in Gibraltar. All the things you thought you understood about normal taxes do not apply to this tax. It stands alone, it has its own rules, and it needs to be considered. So let's get down to what the actual provision amounts to. Well, it's very important to understand what a taxpayer is, because only a taxpayer as defined is subject to the exit tax. And a taxpayer is defined as an ordinarily resident company which has accessible income under the provisions of the Act, or a permanent establishment of any such company resident in another European Union member state or a third country. So a Part 12 branch would be caught, Part 12 place of business would be caught, a Part 14 branch would be caught if they changed their location. But the important things is that we need to know is the company needs to be ordinarily resident already, and as we discussed right at the top of the session, ordinary residence means that the management and control of the company is located in Gibraltar, or it's exercised by those who are ordinarily resident here. It needs to be a company, and it needs to have accessible income. If it doesn't have those three characteristics, the entity is not subject to the tax. Though artificially creating those conditions would obviously be subject to the Commissioner's General Anti-Avoidance Rule in section 40. And he may well ignore any artificial arrangements. It would also probably be subject to DAC 6 reporting, but that would need to be analysed separately. It's also important to understand that this is not just about European Union member state companies with branches or places of business. In Gibraltar, note, by the way, that it says permanent establishment. It doesn't say branch or place of business. So you need to be looking at what the OECD definition of permanent establishment is. And a third country entity with a permanent establishment in Gibraltar is just as much subject to this tax as a European member state company. So what does it actually say? Well, the exit tax applies where a taxpayer transfers an asset from its headquarters in Gibraltar to a permanent establishment in a different member state or third country. So it puts that asset beyond the taxing powers of Gibraltar. A taxpayer transfers assets from a Gibraltar permanent establishment to its head office elsewhere, similarly putting them beyond the reach of the Gibraltar taxation system. If it chose to tax them, it wouldn't tax them as a capital gain, but if it chose to, and a taxpayer transfers its tax residence to a member state or third country, except for any assets retained in Gibraltar, in a Gibraltar permanent establishment. So you can re-domicile, but if you leave a permanent establishment in Gibraltar, then those assets in the PE in Gibraltar will not be subject to the exit tax. And a taxpayer transfers the business of a permanent establishment to a member state or third country. I think essentially the one that you guys are going to see most frequently, is a straight transfer of tax residence. And as our tax residence test is merely about where is the management control, where are the guys that carry out the management control, you need to be conscious of straight changes in the boards of directors. It's possible, if you think about it, let's say you had 2 Gibraltar directors, they were here, they were running the business got bought. They got rid of. 2 Americans that work for the parent company get put in. They never come to Gibraltar, they never have a board meeting here. That's a change of tax residence as far as Gibraltar is concerned. That would technically trigger the exit tax. So the advisors need to be conscious of this. We need to be telling our clients that these things trigger potentials to taxation. So that's where it applies. Like I say, it's going to mostly be a straight transfer of tax residence that's going to trigger it. The other side of the ease of transfer of tax residence is that redomiciling, if your directors stay in Gibraltar, does not amount to a transfer of tax residence. You redomicile and you move your directors there, then it will. But if you just redomicile your company from Gibraltar to somewhere else, then that doesn't trigger the exit tax, I would say, because I don't think that that's tax residence. Unless, of course, the country has a claim to tax residence that it's going to. So it needs to be thought about, but it's not a slam dunk for a change of tax residence. So what's the charge? The charge itself amounts to the taxpayer will be charged tax at the rate set in accordance with Section 24, and at present that's 10%, on the market value of the assets in question, less their value for tax purposes, where those assets would otherwise generate Gibraltar taxable income. So let's take that apart for a bit. Okay, so there's a charge. The taxpayer, which has to be an ordinarily resident company with assessable income, is charged tax at 10% of the market value of the assets less their value for tax purposes, and we'll talk about that in a second, where those assets would otherwise generate Gibraltar taxable income. So a company with no assets will not pay this charge. It has to have assets. Those assets have to generate Gibraltar taxable income. So what's an asset? An asset can be anything. An asset can be a house. It can be a loan. It can be a subsidiary. It can be many things. And the requirement to generate Gibraltar taxable income is probably something which will calm some nerves around this, because this is not all of the assets of the company. We understand that not every asset generates Gibraltar taxable income. We don't, for instance, tax gains on the sale of shares. So if I'm a Gibraltar company and I own a portfolio of shares that have gone up in value and I redomicile to another country, or I change my tax residence to another country and then redomicile is sufficient to change tax residence, then that will not be taxable if I am buying to hold and sell at a later date as an investment. That gain will not be taxable because they do not generate Gibraltar taxable income. A loan with an intercompany loan with accrued interest, the total amount owed of which has risen would probably be taxable because intercompany interest is taxable in Gibraltar. So you need to analyze, or the guys who are doing the calculations will need to analyze which assets do and do not generate Gibraltar taxable income, and then they need to apply the 10% charge to the accrued but not realized capital gain or gain in the value of the asset in question. So how do we work this out? So market value is the value, the book value, the accounting value is what the commissioner has indicated that he will take as the market value for this case, in this case, because on the assumption that it was purchased at arm's length prices. And that will then have deducted from it the value, sorry, my apologies, the market value is the market value today. And then the value for tax purposes is the book value. So the market value is what would a willing buyer and a willing seller, unconnected parties, place as the value of the asset. Deduct from that the book value, or the value for tax purposes, as long as the book value is reasonable and all the rules around giving a fair description of the accounting position have been followed, and that equals the taxable amount. So if you bought it for £100 and it's now worth £1,000, the taxable amount is £900. The tax equals the taxable amount multiplied by 10%. It's as simple as that. It's a classic capital gains calculation. What's it worth minus what I paid for it, and the costs that move forward. I'm guessing a lot of you are thinking about, well, you know, the classic capital gains calculation does actually include a lot of other things, like the cost of the costs incurred in the acquisition, like legal fees, things like that. There is no guidance issued by the Commissioner on this in any great depth. And I think that as we move forwards, we will develop the implementation of this over time. But as ever, the Commissioner is reasonable, and if the case is that a large amount of costs was incurred in the acquisition, I'm sure he would listen to that. But you need to engage with him. There's no procedure, as we'll see later on. There's no definitive procedure on how to cope with this tax. So it's going to be about engaging with the tax office, talking to the Commissioner, explaining that you've got an exit tax position, and dealing with him almost on a case-by-case basis to begin with until the implementation settles down. So what this is a tax on unrealized capital gains which are removed from the Gibraltar taxation system's grasp. It is not about the fact that we don't tax this anyway. What this is about ensuring that we could tax if we chose to. And that's what the aim of the exit tax is. So let's go back to what market value means. There's no detailed guidance, as I said, but it is defined as the amount for which an asset can be exchanged or mutual obligations can be settled between willing unrelated buyers and settlers in a direct transaction. So you just apply the arm's length principle, the ones that you've been thinking about for transfer pricing since we introduced transfer pricing, the OECD rules. It would be good practice to say that the market value of the assets for the tax purposes should be evidenced by an independent valuation or other reasonable evidence. It doesn't have to be an independent valuation, but it has to be reasonable. I'm sure that the Commissioner will be reasonable, but if you turn up with some workings written on a shorthand pad, then he will think about it differently than if you turn up with a copy of a surveyor's valuation report done within the last couple of weeks. So it's all about being reasonable. It's all about being able to present your case properly. And I think what we should try and avoid is a tick box approach where I must get this. What you must do is do something that is reasonable and be willing to say to him, okay, I haven't got a valuation on it, but what I've got is all these pieces of evidence. I sold one last week. It sold for this, that kind of thing. So what does value for tax purposes mean? Well, value for tax purposes has no I say it's got no real meaning in our law, but it has no meaning as a phrase because it doesn't refer to anything. There is no tax for us to have as for it to have a purpose for, because we don't have capital gains tax. So we need to work with those words and try and get them to be reasonably interpreted. So the Commissioner has told me in an email, and this is, he's aware that I'm telling people this, that value for tax purposes will be determined by reference to the book value of those assets. reported in the accounts in accordance with the relevant and applicable accounting standards framework. So you have to follow your standard rigorous test about what you put in the accounts, but they're not necessarily looking for a valuation report going back 10 years, though I'm sure if you had one and for some reason the accounting value was different, he would listen to an explanation. I'm sure he would. He's a very reasonable gentleman. So it has to be paid 10%, and it should be paid as soon as possible. But there is a mechanism for deferral of payment, and it can be deferred for 5 years and paid in installments. But it's for certain very specific cases. So this is where the EU jurisprudence kicks in, because these are part of the rules that were imposed by the Court of Justice of the European Union in the various cases on exit taxes. So the tax can be paid in installments over 5 years, where the transfer of assets, and each of these four mirror the four tests, the four triggers, where the transfer of assets is from a Gibraltar head office to a permanent establishment in the EEA or EU member state, where the transfer of assets is from a Gibraltar PE to a head office in an EEA or EU member state, where the transfer of tax residence is from GIB to an EEA or EU member state, and where the transfer of a business is from a GIB PE to a PE in an EEA or EU member state. Now, I don't know, and I don't think anybody knows, what the arrangements will be when the UK is out of the EEA and the EU, whether Gibraltar will still deem that to be a member of the EEA and the EU because they've implemented a similar exit tax. And that's essentially what the test is. The test is, does the country that you're going to have the same exit tax as the rest of the EU? Is it part of the system? And the shorthand for that is to be an EEA or EU member state. But if UK has the same, then I'm thinking that probably we will see a transfer to the UK as being recognised as equivalent to a transfer to an EEA or EU member state. Though I don't have any indication of that, it just would make perfect sense to me. So the final test is to qualify as an EEA member state. You must have implemented an agreement with Gibraltar for tax cooperation equivalent to the EU directive. There are a lot of tax cooperation agreements. I don't know of any specific ones with EEA member states. I think the EEA is Liechtenstein, Iceland, Norway. I think that might be it. Maybe Greenland. They're not big jurisdictions that we deal with a lot. They're maybe Liechtenstein. So in some cases, that deferred payment, which is great, you get 5 years, it sorts your cash flow out. That's really good. But the deferred payment can be accelerated in certain cases. And that is when the relevant assets or businesses are sold to a third party. The transfer of the assets leaves, the assets transferred leave the EEA, EU zone. The taxpayer's residence or business carried out by its permanent establishment is equally transferred out of the EU or EEA zone. The taxpayer goes bankrupt, that's accelerated then. The taxpayer fails to honour its obligations under the instalment plan. Or if there is a demonstrable and actual risk of non-recovery, in that case, a guarantee might be required from the company or from individuals connected to it, or parents. Some sort of bond might be required. Those things are possible. And again, that is all around the CJ EU court cases. So you'll see what we've got here is we have a tax of 10% on accrued gains from Gibraltar income generating assets of 10. So it's 10% on the gain. It can be deferred into installments over 5 years in certain circumstances. And if those circumstances drop away, then it's accelerated to immediately. Otherwise, it is payable on exit. So just to cover the ground again, that this is it doesn't, for those of us that have studied EU law, this just, the exit tax as a concept doesn't compute. It's clearly should be a restriction on the right to move around the EU. Then the Commission's compromise is, if everybody does this, then it isn't a restriction, because there's no, like, the rules are the same across the board. So that's the compromise they've come to, and that's why they've introduced this, because what was happening was people were moving their tax residence, putting large assets beyond the taxing rights of countries that the company had been resident in for quite some time, and that frankly was an avoidance scheme. What you would do, you set up in France, say, you would build up a business, you would have all your people in France, you would make loads of accrued gains, and then you would move to Luxembourg and you would sell the business. Great, you don't pay any tax, or whichever country, not necessarily Luxembourg. Luxembourg does have any tax. So the key for those who are the accountants in the room is, what is the process? How do I go about doing this? Because the corporation tax return does not allow for the exit tax. There is no way of returning this given the forms that we already have. There is no statutory procedure for filing a return. There is no form. What you need to do when a company, and I've checked this with the Commissioner in the last couple of days, the Commissioner expects a company which is in the position of relocating, even if it doesn't have any tax to pay, I would say, though we didn't say that, but I would say even if it doesn't have any tax to pay, it should be contacting the Commissioner and say, I'm moving my tax residence, I've got no assets that generate any Gibraltar income, therefore, thank you very much, I'm not subject to the exit tax in Gibraltar. I think that's a simple, a letter should do that, some sort of certification from the accountants in question. But again, these are systems and procedures which are developing over time. It is unsatisfactory that we don't have a tax return to file. I think that that is something that will happen. Depends on the workload, I guess. If people are moving lots of companies out of Gibraltar, then I don't doubt that we will automate the process. So that is something that will come down the line, and I know I've expressed my opinion about that to the Commissioner, and everybody agrees that some sort of process would be better than what we've got now. But this is what we have. You need to contact the Commissioner, and you need to contact the Commissioner for any change of tax residence that's occurred since the 30th of January. So I think what you need to do is have some sort of review if you're an accountant or a fiduciary. Probably won't have any tax to pay. It's not that long. Well, we've got 5 months gone by. I think that we've all been dealing with quite a lot of things. There won't be very many tax residence changes in those 5 months, but 30th of January is the relevant date. So that's the end of the presentation. Now, we've got the Q&A system, which frankly I've never used before. So let's give it a go. If anybody wants to ask a question, feel free. Or you can put it on the chat if you would rather do it that way. I don't mind. Or if anybody wants to speak, then, oh, I've got somebody with their hand up. Robert Guest. Hello, Robert, how are you?
I'm fine, Graham. You good?
Yeah, I'm good. How are you?
Okay. Just a quick question. I mean, okay, so we've introduced this this legislation. In the event, say, that Gibraltar crashes out with the UK without a deal at the end of the year, is it likely to be repealed at some stage because it would be no longer applicable, I guess?
So the Spanish tax agreement commits the UK and Gibraltar to implement and maintain implementation of any, I can't remember the exact words, but any EU legislation which is in place on the date we leave. This came into place before we left. So we've got this, and this is what's going to stay.
Yeah, but that tax treaty has not been ratified yet. So,
but the tax treaty is not dependent on us getting a deal. So as soon as Spain,
yeah, but the tax treaty is not in force.
Yes, but as soon as Spain does ratify, it is in force.
No, the UK and Gibraltar have not ratified it.
Okay, it was laid by the UK government, wasn't it?
Yeah, but it's not ratified.
But the point is that is not dependent on, though it may be politically, it's not linked mechanistically to us having a deal or not having a deal.
Okay, all right.
So as long as ratification occurs, it's in, and the UK is committed to ensuring that we maintain implementation of this, regardless of a deal.
Thank you.
Okay. So I've had a question. I've had a question saying, have we seen this paid? I haven't personally had anything that's changed its tax residence as yet. So I've not had to implement this directly. I have had a conversation with the commissioner, and what he's expecting to see is a period of negotiation when you're aware that you're going to be relocating, and he's going to engage with you, and I'm guessing it will be a type of certification from the company's accountants signing off what the position is and what is or isn't taxable, and then a payment across. Sorry, I can't give any more detail. Are there any other questions? Oh, got one on chat. Does it make sense to have a tax ruling from the ITO? Tax rulings are a very difficult subject in Gibraltar at the moment because of, well, they're not a very difficult subject. We have a very different mechanism now. Deepak, hello, by the way. We have a very different mechanism than we used to have. So what we used to do was we used to write, and the tax commissioner would write back to us, and he would tell us what he thought the legal position was, and then that was examined, wasn't it, by the commission under state aid, and there was, of the not very many, I think 5 of the 160 rulings they examined were found to be in breach of the state aid rules, but there was some quite severe criticism of the mechanisms by which the tax office gave rulings. I don't think they were fair. I think what happened was guys from countries like Luxembourg that have a very different approach to tax rulings wanted us to follow that civil law model rather than the lawyer says this is the case, do you agree with our conclusion? They wanted a more inquisitorial approach. So now we have a more inquisitorial approach, and the commissioner has the obligation now to publish tax rulings and to anonymize them, but they will be published. And frankly, my approach to the tax rulings now is that we should not rely on the commissioner to tell us what we think we already know, because it is not his job to give us comfort. it is the lawyer's job, so I'm talking about the lawyer now, it's the lawyer's job to advise the client on the law. Unless it is actually a grey area, I would not advise a default position of taking taking tax rulings as a way to give extra certainty if the position is clear. So I hope that helps, Deepak, but obviously tax rulings sometimes are necessary. So I've got another question. Thank you, Benji. So outside of intercompany loans and IP, where do I see the exit tax being relevant? Well, a company that owns rental properties in Gibraltar would have to pay tax on that. A company that owns a business in Gibraltar, I mean, I know we're not going to see it very often, but a company that establishes a branch here and has leases. I know sometimes we see financial services businesses open branches here for make the passporting a lot easier. If they've got saleable leases, they would be relevant. I think it's not something I expect to see on a daily basis, but there will be more than just loans and IP. But I don't think there's going to be a huge amount. I don't think it's going to create a huge amount of answers. So Carlos has repatriated companies from Gib to Portugal in the past, and it's very easy and welcomed by the Portuguese tax authorities. And it was advantageous to do so because of certain factors. Will this exit tax make it more complex to transfer a company to Portugal? Will it help us with our compliance status and the various lists that we appear on? Well, I don't think this is going to have any impact on the blacklisting question. I would question whether the Portuguese blacklist, given that we're in EU territory, was ever fully legal, and I think it wasn't challenged. But I think it's a practical fact rather than a principled academic discussion that we need to deal with. I don't think it will have any impact on that. That as I remember, the Portuguese blacklist is merely a mechanical calculation of the tax rate is less than a certain percentage of the Portuguese tax rate. I don't think it will make it more complex to transfer to Portugal any more than it would make it more complex to transfer it to anywhere, though I do think that the Portuguese tax authorities will probably start, and all tax authorities inside the EU will probably start asking for evidence of the exit tax mechanism being followed. My dog's just coming. So I think it's going to be more admin, but I don't think it's actually going to be too burdensome, given that the chances are a company that's transferring to Portugal will own a Portuguese property or some sort of Portuguese asset, which would not otherwise be generating Gibraltar income. So I don't think that will be too much of a problem. Are there any more questions? Oh, no. Sorry. Darren. How are you, Darren? Hold on. No. Darren, I think you've got your hand up. Do you want to ask a question? You're on mute, I think.
Right.
Hello, Darren. Yeah, hello. Hello?
Graham, I can't hear you now, sorry. Anyway, okay, my question, Graham, if you can hear me, nod.
Yeah.
Okay, my question. Thanks for that, Graham. On your discussions with the Commissioner, is he expecting to be notified before a transfer of assets as well between the PE and the head office? Or Is he, I mean, often we get notified of that at a later date and not before the event has happened. So it would be quite difficult to notify him and then to notify negotiations before that has happened. For example, there may be a transfer of plant and equipment or something similar.
Okay, so I think what you're asking me is, does the negotiation process apply to all of the triggers rather than just tax residents? I'm sorry if you can't hear me. So I think that that to be brutal, I think probably the situation is that no firm position has been taken yet. I understand the practical problems. I think if you file the return at the moment when the assets are sold, then that will satisfy the test in the law. But I don't think we've arrived at a full position yet. I can't give you any more answer than that. I think this is one of the problems of what's happened in the last few months, and frankly the vast changes that are going on through the taxation system internationally and locally, that things are changing so quickly. Nobody's got any time to think through all the possible ramifications of what's going on, and we are going to have to learn as we go along. I think that the Commissioner will be reasonable. He will not be unreasonable. He is not out to catch you accidentally getting things wrong. So if you go to the Commissioner and say, last week we sold something, there's no need for a negotiation period. I know exactly what the gain was because I sold it. I know what I paid for it. Here is the, all right, not I sold it, but I disposed of it. Here is the value, here is what I paid for it, and I owe you some money. I think that would be, as with everything, go to the Commissioner as quickly as possible if you can't get there on time. Does that sound reasonable, Darren?
I missed all of that because I couldn't hear anything, so you have to repeat.
Did everybody else hear that?
As long as everyone else got it, you can tell me.
Yeah, I'll Darren. Sorry.
That's all.
Okay, are there any more questions, and then we'll just wrap it up because I think I've taken up enough of your lunchtime. Okay. Thank you very much for your time. If there are any questions specifically that you have, please feel free to email me. My email address is graham.jackson@hassans.gi. I believe that the marketing team will be circulating the slides, and I look forward to seeing you at the next session, which I can't remember which one it is, but I look forward to seeing you at the next session, and the marketing team will be circulating invites to that as well. Thank you very much. Goodbye.